IAS 12 Income Taxes, Class Example 3. In this class example, we have to prepare the deferred tax calculation, in which the carrying amounts have been given to us in the form of a statement of financial position and other information, and we have to calculate the tax base and the temporary differences. We start off with property, plant and equipment. Property, plant and equipment consist of several assets, the first one being land, and we have to now calculate the tax base for land. Before we can calculate the tax base for an asset, we have to ask ourselves, will the economic benefits from this asset be taxable? The answer to this question is yes, because we are going to use the land in our business and it is going to help us to make economic benefits in the future. So therefore, the tax base of this asset will be the amount that will be deductible for tax in future. So what will be deductible with regard to land in future? We know that there are no deductions for land. Therefore, the tax base will be equal to 0. The next asset that forms part of property, plant and equipment is the factory building. Now again, before we can decide what the tax base of an asset is, we have to ask ourselves whether the economic benefits will be taxable. And the answer to this question again is yes, because we are going to use this factory building to manufacture inventory that we are going to sell at a profit. So if the answer is yes, that means the tax base for this asset will be the amount that will be deductible for tax in future. To determine what the amount will be that will be deductible for tax in future, we have to look at what the allowances are that the South African Revenue Services allow. And we see here that the factory building allowance is 5% per annum on the cost, not prorated. This asset was purchased on the 1st of January 20X4. Therefore, we have had this asset now for 10 years already. 5% per annum equals a total life of 20 years. So we are going to get 5% per year for 20 years as a tax deduction. If we have already received 10 years worth of tax deductions, that means we have 10 years remaining. So therefore, the future deductions that we will get from this factory building will be the 5% for 10 years. That gives us a tax base of 900,000, being the cost less the deductions that we have already deducted. The next asset is the office building. So again, the tax base of an asset, we first have to ask ourselves whether the economic benefits will be taxable. So obviously we are going to use this office building in our business. We won't be able to have a business if we don't have an office building. Therefore, the economic benefits that we get from this building will be taxable. And the tax base will be the amount that will be deductible for tax in future. If we look at the allowances that we are allowed on an office building, we see here that there are no allowances on this office building. Therefore, the tax base will equal 0. Lastly, we have factory machinery. The question again is, will the economic benefits be taxable from this factory machinery? And the answer again is yes. And therefore the tax base will be the amount that will be deductible for tax in future. The deductions that we are allowed on a factory machine is 15% per annum on the cost. We purchased this factory machine on the 1st of January X9. Therefore, we have already had deductions for 5 years. We have already deducted allowances for 5 years. So the remaining amount that will be deducted in future will be 187,500. The other intangible asset is a patent. Now we have been given the tax base for this patent as 420,000. We know that the economic benefits from inventories will be taxable. When we sell inventories in future, we will make a profit, and this profit will be taxable. Therefore, the tax base will be the amount that will be deductible for tax in future. Now, next year, when we sell these inventories, we will have revenue. And against this revenue, we will be allowed to deduct the cost of sales to calculate the taxable profit. The cost of sales will include the closing inventory of this year. So therefore, the tax base will be the full carrying amount of inventories. In order to calculate the tax base for trade receivables, we have to first look at the additional information in point 4. In additional information note 4, we see that trade receivables is the trade debtors control account balance of 350,000 reduced by the allowance for expected credit losses of 50,000. Therefore, this balance for trade receivables actually consists of two amounts, a debit and a credit. And we will have to look at the tax base for each of these balances separately. We also see that the South African Revenue Services allows a deduction of 25% of the balance on the allowance for expected credit losses each year. So if we look at the gross trade receivables first, we know that that is a debit balance and that therefore it is an asset. So to determine the tax base of an asset, we first have to ask ourselves, will the economic benefits be taxable? The economic benefits from a trade receivables will be the cash that we will receive once the debtor pays. We will not have to pay tax once we receive the cash from the debtor because we have already paid tax on this transaction on the date of sale. Therefore, the tax base will be equal to the carrying amount. With regard to the allowance for expected credit losses, that is a credit balance. So we will have to look at the tax base of a liability. Now, the tax base of a liability is the carrying amount less the amount that will be deductible in future. So we know that we have already received 25% of the balance as a deduction in the current year. That means the remaining 75% will be a deduction in the future. So to determine the tax base, we have to take the carrying amount of 50,000 less the deductions that we will receive in future, the 75%. And that gives us the tax base for the allowance for expected credit losses. To calculate the tax base for other current assets, we have to look at the additional information in Note 5. In additional information Note 5, we see that current assets comprise of dividend income receivable, prepaid insurance, and prepaid subscriptions. We will look at each item separately to determine their tax base. The first item is dividend income receivable. So we know that dividend income receivable is an asset, and if we want to determine the tax base for an asset, we first have to ask ourselves, will the economic benefits be taxable? The answer to this question is no, due to the fact that dividend income is not taxable. Therefore, the tax base will equal the carrying amount. When we look at the prepaid expenses, it's also an asset, so we again have to ask ourselves whether the economic benefits will be taxable. The answer here is yes, because we will utilize the insurance and the subscriptions that we have paid. We will utilize that benefit in future, and from this benefit we will be able to run our business and make a taxable income. So therefore the tax base will be the amount that will be deductible for tax in future. To determine the amount that will be deductible for tax in future, we have to remember Section 23H of the Income Tax Act. Now, Section 23H tells us what amounts we can deduct once we have paid the prepaid expense and which amounts we will only be able to deduct once we have received the benefit from this prepaid expense. So normally we know that expenses are deducted at the earlier of paid or accrual. So will we be allowed to deduct these prepaid amounts in the year that we've paid them. Now, how Section 23H works is we have two rules. The first rule says that if we are going to utilize the benefit from this prepaid amount within 6 months after year end, we will be able to deduct the full prepaid amount in the year that we have paid this amount. So when we have prepaid amounts, we'll look at each of them and determine whether we are going to utilize it within 6 months. Now we see here that for the prepaid subscriptions, we are going to utilize the prepaid subscription within 6 months after year end. Actually, within the first 4 months after year end. Therefore, the full 25,000 would have been deducted in the current year. With regard to prepaid insurance, we see that we are only going to utilize this within the first 8 months of the next financial year. So therefore, the prepaid insurance does not qualify under the first rule of Section 23H. So we now have to move to the second rule. The second rule says, if the total prepaid amounts that did not qualify under Rule 1 are less than 100,000, then we will be allowed to deduct the full amount in the current year. If it's more than 100,000, we will only deduct it in future as we utilize the benefits from these prepaid amounts. So we see here that the 285,000 that was not utilized, would not be utilized within the first 6 months after year end, now falls under Rule 2, and we see that it is bigger than the limit of 100,000. Therefore, we will only deduct the 285,000 in future. Now, the tax base of an asset is the amount that will be deductible for tax in future. And we see that the 285,000 will be the amount that will be deducted in future. The 25,000 would have been deducted in the current year. So therefore, the tax base will be 285,000. The next item on the SFP is cash and cash equivalents. Now, cash and cash equivalents is an asset, so we have to ask ourselves, will the economic benefits be taxable? When we go to the bank and we get the cash from the bank, we will not need to pay tax on these cash amounts again. So therefore, the tax base will be equal to the carrying amount. We have now calculated the tax base for all the assets, and we have to calculate the tax base for the liabilities now. The first liability that we are going to look at will be borrowings. And we see that we have long-term borrowings as well as the short-term portion of the long-term borrowings. In additional information, point 7, we see that the long and short-term borrowings relate to the capital amount of the obligation to the bank. And we also see that included in the short-term borrowings amount is an interest expense accrual in respect of this obligation of 50,000. Therefore, we have to split the long-term borrowings and short-term portion of the long-term borrowings between the borrowings balance and the interest expense accrual balance in order to calculate the tax base. The tax base of a liability is the carrying amount less the amount that will be deductible in future. With regard to the borrowings, we first have to determine the carrying amount. So we have the 1.3 million long-term borrowings, plus then the short-term portion, which will be the balance of 250,000 less the interest expense accrual. Therefore, the borrowings amount itself will be 1.5 million carrying amount. The tax base will be this carrying amount less the amount that will be deductible in future. Now, we know that the capital amounts that we repay on a loan will not be taxable or will not be deductible. So therefore, the amount that will be deductible in future will be 0. With regard to the interest, accrued interest, we have the carrying amount of 50,000, and the amount that will be deductible in future will also be 0 because we have already deducted this interest in the year that it accrued, which was the current year. Therefore, the tax base will be 50,000. Next, we have trade and other payables. In additional info part 8, we see that trade and other payables comprise of amounts owing to suppliers for goods and services of 480,000 and 20,000 that relate to subscription income received in advance. For credit balances, we get two different formulas for calculating the tax base. First, the tax base of a liability, which is the carrying amount less the amount deductible in future, and then a different formula for calculating the tax base of revenue received in advance, which is the carrying amount less the amount not taxable in future. For trade and other payables, the 480,000, we know that these expenses would have been deducted at the earlier of when it was paid or when it had accrued. Therefore, these amounts that we owe to the suppliers have already accrued and have already been deducted in the current year. The amount that will be deductible in future, therefore, is 0. The tax base is the carrying amount of 480,000 less 0. With regard to revenue received in advance, the 20,000, the tax base will be the carrying amount of 20,000 less the amount not taxable in future. Now, income is taxed on the earlier of when it accrues or when it is received. So in this case, we have already received the cash. So we would have already been taxed on this amount. This means that the amount of the tax base will be 0, because the tax base will be the carrying amount less the amount that will not be taxable in future, which is the full 20,000. Just when we thought we were finished calculating all the tax bases, we see in additional information point number 9 that during the year, 25,000 Rand was written off as research expenses in the profit or loss. So that was expenses in the current year that we expensed. Assume, however, that this revenue services only allows this expenditure to be written off in equal amounts over 4 years. So that's 25% per year. Now, in this case, we do not have a carrying amount for any asset for these amounts that we paid, these expenses that we incurred. However, for tax purposes, we do have a carrying amount. So there is an amount, a benefit that we have in future for tax purposes from these research expenses. And that benefit, that tax base, will be the deductions that we still will receive in future. We've already received 25%, so that means there's 75% remaining that we will be able to deduct in future, and that gives us the tax base for these research expenses at 18,750. We have now calculated the carrying amounts. We got that information from the SFP, and we have calculated the tax base for each of these assets and liabilities. The temporary difference will be the difference between the carrying amount and the tax base. So we'll take the carrying amount less the tax base, and that will give me my temporary difference. Let's lastly look at the difference between taxable and deductible temporary differences. If we look at this calculation, we see that the positive amounts are taxable deductions. So why are they taxable deductions? For example, let's look at the factory building. For the factory building, we are going to get economic benefits in future to the value of 1,080,000. However, we will only be allowed to deduct 900,000 against these benefits in future. Therefore, the difference between the carrying amount and the tax base will be a taxable temporary difference. If we look at the patent, for example, we see that the economic benefits that we're going to get in future will be 400,000. However, we will be able to deduct 420,000 against these economic benefits. So we'll be able to deduct more than what we have actually received as economic benefits in future, or what we will receive in future. Therefore, the difference is a deductible temporary difference. Make sure that you understand the difference between taxable and deductible cumulative temporary differences, which is what we have calculated in this deferred tax calculation, and current year temporary differences. Current year temporary differences will be the temporary differences that we will have in our income tax calculation for the current year. Whereas these cumulative taxable and deductible temporary differences will be the future temporary differences that we will have. And that is what we've calculated with this deferred tax calculation. Once you are comfortable with the principles from class example 3, you can now move on to lecture 4, where we will be looking at the recognition of deferred tax assets and deferred tax liabilities.